So, a very warm evening to all. I'm Krishna Priya, and it is my absolute pleasure to welcome you all to the Financial Literacy Webinar Series 2. So, today we are on an excited journey where we'll explore the skills, tools, and knowledge needed to make smart financial choices that can truly shape our future, with a few special focus on personal finance management, the foundation for building financial confidence and long term stability. We are really honored to have with us our remarkable speaker, Ms. Preeti once again. Preeti is a mechanical engineer by training and has built an inspiring career in the field of finance. So, after completing her master's in operations research at Columbia University, New York, she worked with PricewaterhouseCoopers in New York and Seattle, specializing in the financial risk management. So today she is the founder of MPower Girls India, an initiative dedicated to empowering individuals with the art of making informed financial decisions. With her unique blend of technical background, global experience, and passion for teaching, Preeti brings a wealth of knowledge to the session. So let us extend a very warm welcome to Ms. Preeti, and I'm certain her insights will help us all view financial management in a more practical and empowering way. Yeah, over to you, Preeti. We can start when
Thank
we are
you.
ready. All right.
Yeah. Thank you so much for the wonderful welcome, Krishna Priya. I know we're only a few people, but we'll start because this session we try to keep it under hour and a half, but by the time we answer questions at the end, it always becomes very long. So I don't want to uh, start off late. So hence we're starting a bit earlier than normal. Let me share my screen. Can I get share access?
Yeah, sure. I hope you'll be able to share the screen now.
Yeah, let me see now. Yeah, I think so. Yes.
Okay.
Okay. Oops. 1 second. Can you see stuff moving around on my screen?
Yeah, we can see it.
Okay, great.
Maybe.
Yeah, 1 second. It's private access, window picker, directly access to your. Okay, fine for now. Allow. And I'm going to minimize this and I'm going to
Maybe
try.
we can go with slideshow, Ms. Preeti.
There's like one link in. Okay, sure, let's do that. Fine.
On.
I need to switch between this and another Google tab. So we'll see how that goes. All right.
Whatever is convenient to you, we can go.
Yeah, no. Let's go with this and then we can always stop the slideshow if need be. Okay, great. Thank you all for joining. And Krishna Priya has already mentioned what we're going to cover today. This is focused on all you young people who are joining the workforce very soon or who have already joined, and the things that you need to do in managing your money or the income you will be having. All right. So as you start earning, you will have to make many financial decisions. I'm hoping that some of these things that you hear about today will help you be a bit more knowledgeable, and maybe it will give you some tips and tricks in how to manage your budget or how to invest, etc. Okay, we have lots of topics to cover, as I mentioned, and if you have questions, please write them down and we will address all of them at the end of the session. I probably would not be answering them during the session, right? So we'll wrap up all the topics and then we'll address them at the end. All right, so here we go. All right, the first and foremost thing in managing your finances is, what do you want your money to do for you? What do you want to achieve with the money that you are going to earn? So for that, we need to set what we call financial goals, right? why are goals important? We all know that you guys have written exams, you've prepared for entrance exams, for your midterm, for your finals. So anytime any such thing comes up, you're approaching an exam, you set your study schedule. You say, okay, I want to get a very good grade. So what do I need to do? I'm going to study chapters 1 through 5 on this weekend, and then something else on the next. And then you sort of give your study a direction. In the same way, your money management, or what you do with the income that you earn, also needs some direction. Otherwise, we are kind of lost, right? You don't know. Oh, suddenly you become an earning member of, your family, and you really don't know what to do with it. Somebody says, oh, I need, Anna or Bhaiya, I need some money. Can you lend it to me? Sure, you'll be that good big brother and sister who will lend it to your younger brother or sister. That's fine. But you cannot be doing that all the time. So you need to become very disciplined about your financial choices. And by that, I don't mean these small little gifts, but I mean bigger choices, what you need to make with your finances. And you have to resist some impulsive spending. All right. So it's important for you to have financial goals. What are these financial goals? What do they look like? So we have basically, you have a short term financial goal and a long term. And of course, in the middle, there's this medium term financial goal, which bridges the gap between your short term goal and your long term goal. So, what is a short term financial goal? It's something which focuses on your immediate needs. And when I say immediate, I mean some expense that you are planning for, saving for, which is going to happen in the next 1 to 3 years. Now, this could be like you want to take your parents on a vacation, you want to upgrade your phone, or God forbid, there's a medical expense that has been pending and people are waiting for you to start earning, and that's what you want to take care of. It could be any of these. You might be seeing this thing called emergency fund on your screen, which is in yellow, and we will cover that in detail later. So think about a short term goal as something that you need to achieve with your money in the next 1 to 3 years. Now, a long term goal is something which is further away on the horizon, which is like 7 plus years. Right now, when you're young, it feels like 7, 10 years is so far away. Uh, but honestly, you have to start planning for things that you're going to need money for. For example, you want to buy a house when you're maybe 30 years old. Maybe you have children and you want to send them to like a very expensive school. For that, you need to plan, and all these things are far out in the future. Right now, I'm sure you're young and you really don't want to think so far ahead, but it's important to keep that on your horizon. It's a long term, but you need to start planning for it right now. And in the medium term are things which are helping you sort of bridge this. So you've done your short term vacation, your emergency fund is covered. Now let's say you want to buy a car which is not as expensive as a house, or you want to save for a down payment for your home. What does that mean? Like whenever you go for a loan for a house which you're going to buy maybe 10 years down the road, 15 years down the road, you still need to save up a certain percentage of the loan and say, I'm going to pay with my cash some amount, and then the rest I'm going to take a loan. All right. You guys will get married, or maybe your brothers or sisters or somebody in the family is getting married, and you need to contribute to that. So, all these things are in the medium term, and there are things in the long term. What I want you guys to do right now is, in your mind or on your pen and paper, if you have something, please think about some short term goals, financial goals, and some long term financial goals. These are all very personal. My financial goals are different from Krishna Priya's, is different from yours, is different from anybody else. All right. Of course, there will be some similarities, but they're all very personal. So, and we're not going to be discussing them, but I just want you to write these down, because as we go on in our session, we're going to always look back at what my financial goals were, what my investments are they helping me meet my financial goals, what my savings are doing, are they helping me meet my short term goals. All right. So just write it down so that it doesn't have to be very serious, just like whatever. Even if you want to say, I want to have like a silly financial goal of, let's say, being able to order from Swiggy without having to worry about how much it costs, right? Now that's a lot. That can be like 5,000, 10,000, 15,000. I don't know how much you eat or how much you order. So think about uh, things that you want to plan, what your financial goals are, all right? Just write them down and we'll refer to them again. Okay. Now, the whole purpose of this, this event or this webinar that FFE organizes for you is to help you build a very strong financial base. And what do we need for this strong financial base? Most importantly, you need your income, right? Like without an income there is nothing to worry about. If you're not earning money, you don't have to, I mean, it's you're in a bad place, number one. And secondly, there's nothing that you have to worry about in terms of, oh, what do I do with the money that I have to invest, to save, to buy? I don't have the money. So the most important thing for you is to have a strong and stable income. When we always discuss this, I like to think about this as a house, a very strong or uh, sturdy house. So, in order for a house to have, to give us comfort, to give us shelter, to be able to weather the conditions outside, you want it to be strong and stable. And the most important thing in a house is its foundation, right? So, think of your income as the foundation of the house. All right. Next is your savings and investments. These are the bricks and walls. Okay. Now, this represents how strong your house is, how much it can protect you. Let's say there's some major, let somebody falls sick or somebody has an accident and cannot work. Can you rely on your savings, on your investment? Is it strong enough to support you, right? So this represents your security and any kind of managing any kind of instability in the future. All right. And the last but not the least is your spending habits. Now, spending is what we think of as the doors and windows, right? For any house, if you just make it like strong walls, strong roof, great foundation, but no doors and windows, you are not going to enjoy that house. So you need to spend some of your money to enjoy your life, of course, right? Just like your doors and windows will help light come in, will help the breeze come in, and you'll be like, oh, wow, what a wonderful view, or oh, this is wonderful. I love my house, right? So, in the same way, your spending will help you enjoy this income that you're earning, but you have to make sure it is balanced so that you are not spending too much, right? A house with too many doors and windows will weaken its structure. In the same way, too much spending and impulsive spending and not enough saving will also impact your strong financial base. So these three topics we'll cover in detail. In fact, we'll spend a lot of time on your savings and investment part. Um, so let me just show you what all we are going to cover today. Yeah. So we're going to obviously cover the top three things that we discussed just now: income, savings and investments, spending. And then we'll cover these two other things which always come up when you talk about financial stuff, like, oh, should I buy insurance, or what should I do? How should I repay my loan? So we'll cover that also briefly. All right. Let's start with income. Okay. In income, we're going to talk about things because most of you are probably getting job offers and some of you may have already started. We want you to understand what your paycheck actually means, right? Not your paycheck, but like when you get an offer letter, what does that mean? What is CTC? What is my in-hand salary? Like CTC sounds great, but at the end of the month, how much money do I have with which I will do my saving, my spending, my budgeting, everything else? All right. And then, of course, we'll cover a little bit of income tax. Okay. I just want to see if I can. Yeah. I'm going to switch to this. Let's see. We'll start with this. Oh, sorry. One second. I'm just going to copy this. Please let me know if you can see it or you can't.
Yeah, the screen is visible.
Screen is visible. You can see
Yes,
what's
yes.
going on. Okay, great, great. Just going to hit play. I wanted to make this bigger, but let's see. Hmm. Let's give it some time. What will be my CTC? Hmm. What will be my CTC? Unattractive depictions. Be my CTC. All right. You see that? It's not going to be as depressing for you guys, I promise. Your CTC will not be, it will not be, I don't know how many crores, 250 crores he wrote, but I'd be happy if it is. But of course, the ratio will not be as terrible as that. All right. So, first of all, what is CTC? CTC stands for cost to company. Okay. And this is the total cost that the company spends on you in 1 year. So whenever you get an offer letter, you will get it for your annual income. All right. What's your gross salary? Your gross salary is your CTC minus what the company or your employer contributes towards your EPF, your gratuity payments, etc. And then what is your net salary? This is your net salary. When I say it means what you get in hand, what you get, like the money that you can actually count, like, this is the money I can spend now. That is your gross salary minus your employees, your contribution to your provident fund, any deductions that you have, and of course, the tax which is deducted at source. All right. Hopefully, this will help it make a bit clear. So imagine this circle. You see that little fluorescent greeny bluish circle. That whole circle is your gross salary. And if you add to that big circle your employer's contributions, then you get your CTC. But what you really get in hand is that gray area, the gray area where I've written in hand salary, this part, when you've removed all your deductions. All right. And why do we even bother with gross salary, right? Like what actually at the end of the day I'm getting to spend is my in hand salary. But why is gross salary important? Gross salary is important because a lot of times when you let's say you're applying for a loan, etc., they don't want to know your CTC. They want to know your gross salary. When you are, for example, you've worked at this employer for a few years and you want to talk to your manager for a raise, like I've been working really hard, I want to get a raise, you need to mention your gross salary and not your in hand salary because that's a smaller amount. You say, oh, my gross salary is this, and I really hope that you can give me a little higher salary, gross salary. All right. So that's why we want to figure out what the gross salary is. And in hand salary, of course, we need what we are going to, spend our money on, etc. Okay. Now, CTC, I'll just go into a little more detail and we'll talk about this provident fund business on one slide. CTC again has two components. Like the first is obviously the direct monetary compensation that you get. That's your basic salary, your HRA, leave travel allowance, any bonus or commission you're getting. And then there is this indirect compensation where the company is paying to like a health insurance provider on your behalf. You're getting paid leave. You're not working, but you're getting paid leave, right? They're contributing towards EPF, towards gratuity. You're getting some perks. For example, you're getting food allowance or, transport services, etc. And for example, if you join a startup, they may give you employee stock ownership plans, ESOPs, right? Where they'll say, we are going to give you 1,000 shares. Okay, but that 1,000 shares will vest over a period of 4 years or something. That is the vesting period. You will not get that money right away. You will get it over a period of 4 years. And even in that, they have something called cliff period, which actually means that you have to work at that startup for at least that time period. If a cliff period is 1 year, you have to work for 1 year and then your vesting starts. So suppose you join a startup and then you leave within a 1 year, you will not get any stock ownership plan ESOPs, right? Okay. You can ask me questions about this later if you have, but I just wanted to include this because this is indirect compensation. You're not getting it right now, but your CTC value becomes really big. It looks, wow, like I'm getting so much money, but in honesty, it's like going to happen over a period of 4 years. Okay. EPF, right? We are talking about EPF because the employer contributes to your employee provident fund. What is this? This is really a retirement savings scheme. I know you guys are young, but just for your information, you start saving for your retirement in your 20s. Please don't wait till you're 30 or 40 or you think like, Arey, I'm so young. Why do I need to invest right now for retirement? I've just started my job. But no, you ideally you start on day one. And that in a way is what your employer is doing for you by contributing to the provident fund. So in what happens in a provident fund is that you contribute some amount and the employer also contributes. So it's 12% of your basic salary. There's no like discussion around this number. It's 12% and it's 12%. That's it. Okay. This the employee provident fund, it accrues interest over time, and you can withdraw the funds when you retire. There's a certain age. But suppose you want to withdraw before that age limit, like if you have a medical emergency or you want to use that money for constructing your house, then you can withdraw it. And this amount is tax free, except if you withdraw, if you've just worked for 5 years and you're withdrawing more than 50,000 rupees, okay, then this is going to be taxed. That amount that you withdraw is going to be taxed. All right. So the contributions to a provident fund are made by you, the employee, 12% of your basic, and the employer, the company you are working for. And this amount is included in the CTC. Got it? Going back to this is the employer contribution to your provident fund. Okay. Now, yeah. How do we get the gross salary? So again, CTC minus the employer's contribution to your EPF and gratuity. What is gratuity? If you think about gratuity, the word itself sounds like gratitude. It's almost like a way of for the company to say thank you to you if you have worked there for longer than 5 years. If you worked at a place for less than 5 years, you are not eligible to get any gratuity. Okay, and they have a formula for calculating this. So suppose you've worked for whatever number of years. So you'll put the number of years here, let's say 7, whatever your last monthly salary was, you're going to put that here. And then you multiply by 15 divided by 26. And that is because they say we'll give you 15 days worth of money or salary per year that you have worked. And then we are dividing last drawn salary by 26 working days per month. Okay, so it's 15 by 26. That sort of explains it. Don't worry, it's not like a random fraction. Okay, and this amount is tax free up to 20 lakhs. All right, so both these things make your CTC appear larger, but it is going for you somewhere in the provident fund, somewhere in the gratuity, but you're not getting it in your hand right now. All right. Net salary. Now, from your gross salary, if this was your gross salary, CTC minus EPF and gratuity, from there you have to remove the tax that already comes removed, actually, the TDS, which is tax deducted at source. Then what you contribute to your provident fund, another 12% of your basic salary. And then deductions, any health insurance you are buying, any professional tax you have to pay, etc. Okay. And then you end up with your net salary or your in-hand salary. All right. Now, the table below at the bottom of your screen gives like a back of the envelope calculation for how much your monthly salary would be if your CTC is depending on your CTC. So if your CTC that you're getting offered is 10 lakhs, less than 10 lakhs per annum, then you divide that number by 13 or 14. For example, let's say somebody gets 9 lakhs per annum. CTC, you divide it by 13, then you get around 70K. If you divide it by 14, around 65K. This is the amount that is your approximate value of what you, not value, or approximate amount that you will get in hand. Okay. This is not gross salary. This is net in hand salary. Now, suppose somebody's CTC is greater than 10 lakhs. So you suppose it's 12 lakhs, you divide that number by 15, and that gives you an approximate value of what your CTC will be. What your in-hand salary will be per month. All right. Okay. So let's start with, I have this person that I've thought of. The person's name is Arya. Arya is about 24 years old. Arya has just landed his or her first job in Bangalore, and the annual CTC package is 8 lakhs. Krishnapriya, I'll need your help to ask the first question in the poll. What is Arya's approximate monthly in-hand salary? Guys, if you can just use the poll feature and put your responses. So Arya's CTC is 8 lakh per annum. If it is less than 10 lakhs, then you divide it by 13 or 14. If it is more than 10 lakhs, you divide it by 15. Yeah, okay. A lot of you are saying less than 50K. A lot of you are saying around 60K. Let me also calculate on my phone. 8 lakhs divided by 13 gives me 61,538. And if I divide it by, 1 second, 8 lakhs divided by 14 will give me 57,142. So approximately 60,000 is what what Arya will get in hand. All right. Yeah. So it's not less than 50K. It's closer to 60K. 63 is on the high side and 57 is on the low side. All right. Thank you. I'm just going to hit end poll for this one. Thank you, guys. Moving on. Yeah. So this helps us. Sorry. Yeah. So we figured out Arya has got 8 lakh CTC. Her monthly, let's just say for approximations, her monthly in hand is 60,000 rupees. All right. So that is how you get from your CTC, go from CTC to the monthly in hand salary. All right. Next. So first topic is done, guys. Congratulations to all of us. Now we'll move to taxation. Okay. Income tax. I know that a lot of people think, oh my God, what is this? I have to pay income tax and what good is it for me, etc. I want you to not think like that, number one, because please think of it as a badge of honor that you are earning enough that you can contribute to your country's development, all the roads you're using, airport, train, anything that you're doing, using, any kind of infrastructure that you're using is thanks to the tax people are paying. All right. The fact that our army is strong enough to support us, everything depends on us paying taxes. So please take it as a badge of honor, pay your taxes. All right. So now in this, I'm going to quickly go over a few terms that are important to know. And then I will not focus too much on this because we got some feedback that, oh, this was a bit too much. I'm still in my final year. I really don't need to learn about taxes, but I'll still teach those of you who are interested. All right. So first key term, what is previous year. So you guys, I'm sure, know that the your tax year starts from 1st April and goes to 31st March of the next year, right? So an assessment year is, so last year's 1st April to this year's 31st March is called previous year. And assessment year is any time after 31st March till I'm sorry, any time after 1st April onwards till my deadline of paying taxes, which is again 31st March. Okay. So if last year is my, in tax terms, is called previous year, then this current year, today, what we are in is our assessment year. All right. So you assess your taxes for the previous year, for last year, which began on 1st April to March 31st, and then you pay your taxes in this year. This year you will pay for last year's taxes. Okay. So the next thing is heads of income. Heads of income is basically the income tax department breaks down where all you can probably get your income from. Of course, salary or pension is the most important one. Then other sources are, you have a savings bank account, you're earning interest on your account on your FDs, or you're a very good investor, you have sold and bought some stocks and mutual funds, or you have a house that you have sold and you've gained some money, which is called capital gains, or you're renting a house, you have rented your house and you're earning some rent, right? So that is also income. And of course, if you are a private professional, you're not getting a salary, but you have a business and you're running a business, whatever income you get from that. So what happens is you have to get all these incomes, whatever, if obviously a lot of it may not apply to you, but everything else you have to add up, and that becomes your total income. Now, total income is not the amount on which you are taxed. Okay, the taxable income is your total income minus deductions. Okay, if there are any deductions, we'll talk about deductions in the next slide. What the government is saying is that thank you for paying taxes. We are going to help you reduce your tax liability. Instead of charging you on your total income, I'm giving you an opportunity to put your money in provident fund or to give to charity, etc. And you can deduct all that from this gross income. And then you come to a slightly smaller amount, which is your taxable income. Okay. Taxable income is the amount on which you are going to pay taxes. TDS, tax deducted at source. It means that the person who's paying you this money, your employer, or the interest that the bank is paying you, they anyway deduct some taxes. Okay, so you have to keep an eye on this TDS. Make sure that whatever tax has been deducted, you're not double paying it. Okay, now when I say deductions, this confusing sheet is here for you. You use any of these deductions. There's always a standard deduction. There's two regimes of taxation, which we are going to get into in the next slide. In the old regime, you could deduct a standard deduction of 50,000 rupees from your gross income. From your gross income, you could deduct 50,000. Or if you made some investments in EPF, etc., up to 1.5 lakhs, you could deduct, or 80G, if you make some charitable contributions, you can deduct that amount as well. And also interest, if you have taken a high interest or you've taken a higher education loan. Suppose some of you want to go do your master's or MBA and you take a loan, then the interest that you pay on that loan is also deductible. Okay, so after you add up all these deductions, you subtract it from your gross income and you reach your taxable income. Now, this taxable income is what you have to go and see. In what slab, 0 to 4 lakh, 4 to 8, 8 to 12, where does this taxable income fall? In 0 to 2.5, 2.5 to 5, where does this fall? And then depending on the percentage, you have to calculate your tax. All right. Now, why is this? Why do we have two different rates here? So our income tax or taxation has been it's going through a whole bunch of reforms. So our government wants people to spend, to not feel restricted because they're being taxed so much. Hence, they're adding many levels here. As you can see, the new tax regime is on your left hand side and the old tax regime. So here in the old tax regime, there were only 4 slabs. So either if your salary or your taxable income was up to 2.5 lakhs per year, then you had to pay no taxes. Then the next slab was 2.5 to 5. Then it was 5 to 10. And everybody 10 lakh and above had to pay 30% tax. All right. Now imagine you earn 11 lakhs and somebody earns 11 crores. They both of you have to pay 30% tax. Okay. Now that has still not been sorted out. But there's things like cess and education cess and things and all which people who are earning a lot more have to pay. But at least in the 0 to 12 or 16 lakh bracket, they've made a whole bunch of smaller slabs. So first of all, the good news for anybody whose taxable income is only up to 4 lakhs, they have to pay no tax. Then your 4 to 8 lakhs is 5. As you can see, it's 10, 15, 20, 25. Every 4 lakhs, it increases. And then if you have 24 lakh and above taxable income, then your tax rate is 30%. Okay. This other box that you can see, there is no tax for income up to 12 lakhs. This is under the new regime. How does that work out? Here you can see that you have to pay 5% here, 10% here. What does this even mean that it is no tax? That is because it allows you a tax rebate. Okay. 1 second. In my next slide, I think you can see. Yeah. Okay. So first of all, this is a comparison of new and old regime. If you don't select a regime, automatically the default regime for tax payment is the new one. All right. And for most of you, if your taxable income is less than 12 lakhs, I don't think you need to worry about opting in for the old regime. This is for people who have many different types of deductions. Okay. Then it makes it worth it for them to go for the old regime. For the new regime, if you don't have very few or very little deductions, then you please stick to the new regime, especially if your gross or sorry, your taxable income is up to 12 lakhs. Okay. Now, please note this tax rebate section 87A. Okay. So, when you calculate your taxes, if the tax amount comes to anything under than 60,000 rupees, suppose you calculated your taxes and it came to 58,000 rupees, you don't have to pay tax because of this section 87A, which gives you a 60,000 rupees rebate. Now you calculated your taxes and your taxes are 65,000 rupees. You calculated it on your slab, etc. You don't have to pay the full 65, you have to pay the 5,000 rupees because, again, using section 687A, there's a discount or a rebate of 60,000 rupees. That's what they mean when they say that those earning up to 12 lakhs, salaried people, okay, earning up to 12 lakhs don't have to pay any taxes. All right. Okay. Back to Arya. So Arya is 24 in Bangalore. CTC is 8 lakhs. And he or she has no major deductions. Krishna Priya, I need the poll. Which tax regime should Arya opt for? Should she opt for the old regime or the new regime? She has no major deductions and her income is about 8 lakhs. Please use the poll and let me know if this makes sense, what I just talked about. Yeah, great. 1%, 2%, 2 on 2. 3 people. Okay. All right, let's see. Yeah. Excellent. Yeah, so looks like some people are paying attention. I'm so happy. That's right. So if Arya's CTC is 8 lakhs, then obviously her net gross income, etc., after all those things, deduction, blah, 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 will be much less than 8 lakhs. And she also does not have any major deductions. Okay. So it makes sense for her to stick with the new regime. Okay. Thank you. All right. We're going to stop sharing this. Thank you very much. Yeah, I'll just shut this. Okay. That's right. So Arya should stick to the new regime. Okay. So how do we calculate our taxes? Again, like we said, you gather all your heads of income, the 5 heads of income that we discussed. If you're using the old regime, please subtract the deductions. Come up with your taxable income. Go and figure out what tax slab you have to pay, where you land up, calculate your taxes, check how much TDS has already been paid, and pay the remaining tax. Okay. If your tax liability is more than 10,000 rupees in a financial year, please pay advance taxes. Okay, because the government doesn't want you to wait till March 31 of next year to pay all your taxes. If you do that, then they often charge you some interest rate. So you have to pay a certain percentage, I think 25 in June, then for 45, a total of 45 by September, then 75, and then the 100% by March 31st. So this is if your tax liability is greater than 10,000 in a year. Okay. So you have to pay advance taxes. All right. That was that. Back to Arya. So Arya is 24, 8 lakhs CTC, no deductions. You guys guessed it right. She's going to follow the new tax regime. Not just yet, not just yet. 1 second. Let me just, I'll
Sure,
let you
sure.
know.
Okay,
No
okay.
problem,
Let
no
me.
problem.
All
Yeah.
right.
So, first step, let's see what her gross salary from her CTC is. So, all the PF, gratuity, etc. Gross salary is about 6,56,000. This is just like a back of the envelope calculation again, like 12% of her basic, etc., karke, we have come to this figure. Now, whatever her standard deduction is, what is her standard deduction in the previous slide? 1 second. Here, standard deduction under the new tax regime is 75,000. So this deduction everybody is allowed to make, and you don't have to submit any paperwork for this. Okay. So she made this standard deduction. So now her taxable income is 5,81,000. Okay. So she goes, she checks the new tax regime slabs, 0 to 4 lakhs, she has to pay nothing. 4 lakh and 1 rupee to 5,81,000. Okay, she calculates it, la la la. Her tax payment is required is 9,050 rupees. Now, remember we were talking about Section 87A rebate, where if your tax uh, liability is less than 60K, you don't have to pay taxes. So finally, she has to pay zero taxes. Okay. Arya does not, she or he does not need to pay any amount of tax, even though this is the amount that she has come up with. Okay. Now the poll. Since Arya's tax liability is zero, should she or he still file the income tax return? Should she file it or he file it? But she doesn't have to pay it. Now, Krishna Priya, you can open the polls. Thank you. Should Arya file even though her tax liability is zero, right? Like the rebate made sure like 9,550, she doesn't have to pay taxes. Should she still file her income tax? Okay. All right. We have some people who are saying yes, some people who are saying no. Okay. We'll wait for a few more responses and then we'll stop. All right. So looks like there's some people who think that Arya should file her income tax return, and there's some people who think that she shouldn't. So it's like 33% of you think, of those who have responded at least, think that she doesn't need to file her income tax, and then 60-70% of you think that she needs to file her report, income tax. The answer is she needs to file her income tax return. No tax payment does not mean no return. You have to still file your tax return. Why? Because number one, if your gross income is more than 4 lakhs, it's actually a legal requirement. You're supposed to, legally, you're required to file taxes. And then when you file taxes, this tax return can be used for many things. When you're renting a property, they'll say, just make up some pay slip. I want to see your tax return. You're applying for visa somewhere or for a loan. They want to see that you have actually filed a return, if you have income or not. Sometimes you might want to claim a refund. For that, if you haven't even, not this year, let's say you didn't file this year, but next year you've not filed your taxes, it's always better to file your taxes, okay? And your compliance. They just want to make sure how, okay, this person is paying their taxes, even or filing their return, etc. Okay, so no tax does not mean no ITR. Even if you don't have to pay any tax, you still file your tax return. Okay, this is all like grown up problems. Yeah, how easy life was, right? When you were in college, no need to worry about all this tax shacks. Anyway, all right, we're done with income. Now we move to smart spending. Okay, smart spending has two main things that you need to always think about in your mind. What are my needs and what are my wants? So, needs are something that are essential, that you really need it to live. Okay. And what are my wants? These are things that would be nice to have. Okay. We'll go in a bit more detail here. So I cannot live without a house, some food, these days, phone. But again, if I don't have my phone, I can manage. But I really need the food. I really need the house. If I fall sick, I need doctor's attention, right? So these are some needs. These are essential expenses. And what are wants? These are discretionary. Like, do I really need to spend on this? Do I really need my latest phone? No, I can manage with not that great or not the latest phone, but my phone does everything I need. Do I need to order from Swiggy every time I have this craving? No, I can hold off and just eat my, dal chawal or whatever it is I'm eating, right? Do I really need to take luxury vacations when I can just stay at home and relax and watch some Netflix, right? Like these are things that you want to think about, right? These are your wants. Do I really need to join cult fitness just because I'm earning money, or should I just spend money and buy some running shoes and go running every morning, right? So if fitness and my health is one thing, and what do I do for each, right? So I want you to think about it every time you open your wallet or your GPay or your Paytm, whatever you're using. Please evaluate every purchase. Is this a need or is this a luxury? Do I really, do I just want this thing, or do I, really need it? Okay. And the more money you earn, the more you should ask these questions. I'm encouraging each one of you to become a little conjuice. Just because you're going to earn money doesn't mean you just start spending it, okay? So please think about your needs and your wants, differentiate them, okay? Now, once you've figured out what my needs are, what my wants are, then budgeting becomes easier. Okay. So, and don't think of budgeting as like this hard and fast, boring thing that, oh, now I have to sit and make my monthly budget. No, it's something exciting. It's an opportunity for you to save money for something you're dreaming of. Like, I really want to go on that vacation. I really want to have that phone. So you're putting money aside for it, right? This is in your budget. You're saying, okay, every month I'm going to save 7,700 rupees or whatever towards this item. That is a way, a budgeting makes it possible. All right, if you just spend your money, you may not be able to achieve those, even those small tiny goals and dreams. Okay, now, since you guys know what your needs are, like your rent, your groceries, utilities is your water, electricity, phone, internet bill, your transportation, these all fall under your needs. So let's say you're earning money, and you must you have to sort of manage it. Think about it like, I'm going to manage all my needs in 50% of the money that I get every month. Now, I want to enjoy some my life, so I'm going to spend some money on my wants. I actually don't like this 50/30/20 is like a rule out there, but the most important number in this, I feel, is the 20% savings or investment. Whether or not I spend any money on my wants, I want to save 20% of my monthly income, my monthly in hand salary, in savings or investing. So think about it. You're earning 10,000 rupees, you're saving 2,000 out of that. So you're now going to have to manage everything in 8,000. Okay. So think about your budget and divide it accordingly, right? Now, you suppose you don't have that many wants. Please put that towards your savings and investments. Okay. So this 50/30/20 is a flexible rule. But that 20% is, think of that as inflexible. That is the minimum you have to save or put aside. Okay. Everything else is a bit more fluid. Okay. Now, some tips. Okay. Once you start earning, or if you're already earning, create a monthly budget. Say, okay, I'm going to follow whatever percentage. Let's say your needs are higher. You're living in a metro where your rent is very high. So maybe this number goes to 60. Then 20 you anyway have to do, and your wants will then have to be curtailed to 20%. So it could be 60/20/20, right? So please create a monthly budget in the beginning of the month, or once you get your CTC and you say, divided by 12 or divided by 13 or 14, whatever my in hand is, I'm going to create a monthly budget. Create it. Done. That is there in your Excel spreadsheet. Now, next, you please track your expenses, even if it is the smallest auto kharcha or anything, or if you're paying everything with Google Pay. Please go at the end of the month or every week, look at your expenses and note it down elsewhere, so that there's another way for you to sort of see where your money is going. Okay. Now, for big purchases that you want to buy a phone or you want to buy a new laptop, try not to buy it on your credit card. Please save money for these large expenses. Okay. Because credit card, why you shouldn't? Because they obviously are allowing you to spend as much as you want really quickly, but they also charge very high interest, extremely high interest. So you don't want to get into that trap, into that debt trap. Okay. Uh, and please control your impulse spending. Impulse spending is like, oh, you're walking with your friends in a mall and you suddenly see this very nice shirt or very nice dress. You don't need it, but it's on sale and you say, oh, let me just buy it. It's like 30% off. The fact that it is on discount doesn't make it better. You're still spending money towards it. It's an impulse purchase. Think about it. Do I really need that shirt? Do I really want this, that shoe, this, that? Try not to uh, give in to your impulses as far as like spending money on this is concerned. If you have actually gone to the mall to buy a shirt, then please go look for the best deal. Why 30%? Go for 50% off, right? I love doing that. I love not, I never go to malls, but online, I'm like, okay, sort by highest discount. And then I find my clothes. It gives me a lot of joy. Anyway, the other rule which controls your impulse spending is postponing the purchase by 24 hours. So suppose you went, you saw and this shop is on the way to college or on the way to work every day, and that shirt is calling your name, Preeti, come buy me. Say, no, I will come back 24 hours later. And if I really want it, at that time, you have controlled your impulse. And this will work with bigger ticket items better. So you want to buy a TV, or because IPL is coming, or you want to buy like you have a party, you want to buy a nice speaker. Think about it. Can I not put my phone in a paper cup? It'll work like a speaker. Like, do I really need to spend like 5,000 rupees on a speaker? Whatever the amount is, right? So control your impulses, wait for 24 hours. You will realize that, you can justify buying it or not buying it either way. It really depends on you. Okay. And of course, live within your means. That is like the main thing that you need to remember. Okay. We're back to Arya again. Let's look at her budget. So she is her in-hand salary is about 60,000 rupees per month. Now, she or he has made some financial goals. They have a 5 lakh, maybe it's an education loan, or maybe her or his parents took that loan and now it's Arya's responsibility to repay it. So that's a 5 lakh loan. Arya wants to make sure that all his or her bills, house, electricity, phone, everything is paid on time. There's never a late fee that she has to pay, he has to pay. And then, of course, because I'm earning, I want to enjoy life a little, travel a little. I have this trip I want to go to, and I want to watch a movie maybe and eat out once in a while with my friends. And of course, I want to start saving for the future. So Arya has thought about a lot of things. I'm sure when I asked you to make your financial goals, some of this may be in your list, but think about it. Okay. So now think about your goals and how you would manage if you were getting 60,000 rupees per month. Okay. So let's see. Arya is spending about 18,000 on rent, food about 8,000, transportation 4,000, loan EMI, this education loan, I've just said it could be anything, is about 10,000. So all these, the top four are her needs. She has to pay this. If she doesn't pay the loan, the interest will be higher. She just has to pay it. So the added up of all this, her needs are about 67%. She's way beyond the 50% thing. But the good thing that looks like she's doing is that her savings are about 24%. Let's see what she's saving on. Okay, her wants are entertainment and shopping. She says, okay, I'm going to spend 6,000. That's 10% of my income on that. Fine. She's saving for this trip. Very good. Retirement, excellent. Looks like she attended this session, and so she's already investing for retirement, and she's creating an emergency fund. What is an emergency fund? We will talk about it in a bit. So this amount comes to about 24%, which is wonderful. Like, she's at least saving 20% and above, and her needs are high, no problem. So she's curtailed her wants. This is like 23 point something. Don't worry. I know my math is a little off 6. This is like rounded up figures. Okay. Now think about a poll now. Arya suddenly gets 1 lakh bonus. The very diligent worker, they've given her 1 lakh bonus. Where do you think this money should go? Should she or he repay the whole debt? Not the whole debt, what a large amount of it? Should they build an emergency fund in one shot? Should she add it to her travel savings or spend it on entertainment and shopping? Yeah, come on. Life is short. I've been given a bonus. I'm anyway saving so much. Okay, very nice. Great. Yeah. No answer is wrong. Thank you. Thank you guys for responding. Yeah. So Arya can choose, she can repay the whole a large amount of the 5 lakhs with this 1 lakh, which would be very good. Or she says, an emergency fund is really, when you're saving up 3 to 6 months of your monthly expenses. So let's say her monthly expenses are about 67, which is like 36, 38, 40,000 rupees a month. She is trying to say, I have to save 40 times 3, at least 1,20,000 as an emergency fund, so that even if I lose my job, I can stay in this house and look for a job for at least 3 more months, or I don't have to like ask my parents for money for khana pina, etc. So that is an emergency fund. So any of this is fine, and it's okay to spend a small portion on entertainment and shopping, obviously not all. Okay, any of the top three are great. Spend a little bit, go have a nice party, but don't spend anything more than what you would spend in a month on that entertainment and shopping. So out of 1 lakh, I would give permission to Arya to spend only 6,000 on wants. Okay, great. Great job, guys. Looks like this is working very well. Okay, now we are on the savings and investment topic. The most important, the reason why we earn money is obviously to spend it on things we need and want, but also to plan for the future. And that's where your savings and investment help. Okay. Yeah. So we're going to cover many things. But we're going to focus a lot on mutual funds. So please bear with me as we go through the other things. Okay. Now we'll start off with tips. Um, and I'm doing that because we just talked about 20% of your monthly income should go towards saving. Now, suppose your expenses are very high and 20% is too much. Don't feel bad. Even if it is like 1%, 2%, 5%, whatever it is that you are able to save, please put it aside. And when I say save, don't think about it as just a bank account. I just think about it as saving and investment, right? Even if it is a very small amount, not 20% of your monthly income, please put it aside, whatever you're able to do it. Okay. And one way to do that is saying, this point number two is saying, this is the most important expense that I have. Saving money is my most important expense. So first thing, if I'm getting, whatever money I'm getting, 20%, if I'm able to, I'm going to put that aside. Now, whatever I'm left with, if I've, let's say, just for practical purpose, if I get 10,000, I'm going to put 2,000 away for saving. Now, the rest of my expenses, my needs, my wants, etc., I'm going to manage in the 8,000 rupees if it's possible. So think about it as an urgent bill, like, oh my God, this is a bill that I need to pay before any other expense. That way, you'll develop a very good and easy habit. Okay. Now, back to the emergency fund that we said, oh, Arya can save for the emergency fund. This is whatever my living expenses are. Here, again, we are not thinking about wants. We're only focused on the needs, because those we need, that much money we need per month to survive in a city like Bangalore or Delhi or Chennai or wherever you are, right? We need that much money. So if my monthly expenses are coming to 40,000 a month, then I need to save. This needs to be my highest priority before I can invest in mutual funds, before I can do anything else. This is the first thing you guys should do when you start earning money. Figure out from your budget. After a month or two, you will know how much your needs are, right? And please start putting some money aside and quickly make this your short term financial goal, that I want to create an emergency fund within the next 6 months or within the next however many months. All right. Please start small and increase it to about 6 to 9 months. And then you will have no tension, in the sense that you will be like, oh, okay, something has happened. You can always dip into this emergency fund for emergency expenses also. There is no hard and fast rule that this has to be used only for if you lose a job or if something happens, right? This can be covering medical bills or anything. So please come up, do this, build an emergency fund. All right. Next, this Again, please begin investing when you're in your 20s, which is right now. Okay. Mr. Warren Buffett, the famous Warren Buffett, said, start early. So think about your investments as he said, I started building this little snowball at the top of a very long hill. The long hill is his life. And he started with a small ball, which means he started investing a small amount. The trick is in having a good fruitful investment is to have either a very long hill. You cannot predict how long your life is going to be, or starting very young. Either you start very young and then you can end up with that really large snowball at the end, or you start somewhere here and you have to invest a lot of money. So here, this table will also help you understand. So suppose you've created your emergency fund, etc. Now you're 25 years old and you say, okay, every month I'm going to invest a small amount. I'm hoping this is a much bigger amount. Let's just say you say, I'm going to invest 3,000 rupees a month till I turn 60. Okay. So how many years is that? That's 35 years times 3,000. It's about 12.6 lakhs till you are 60. I know it's hard to imagine what life would be at 60, but till then you have invested 3,000, 3,000, 3,000 per month. And now you have invested total this thing at the age of 60. This is actually at 10% returns, not even fancy, very like 15%, 17%. No. 10% returns. Your investment is now valued at 1.13 crores. Now, let's say you missed the boat at 25 and at 30 and at 35, and you woke up when you were 40 years old and you said, oh my God, I have not saved for my retirement, or I have not saved any money. Let me start saving. And I have to put in a lot more money than 3,000 rupees a month. So now I'm paying 15,000 rupees a month till I am 60 years old for 20 years. That is 36 lakh rupees. And even then, my final investment value at 10% return is going to be less than what I would have got if I started at 25. You see, it's only 1.03 crores, even though he has spent almost three times extra money, like 12.6 versus 36 lakhs. But his investment is still valued at much less. So please start early. Okay. Thank you. Next. Now, yeah. So, okay, look back at your financial goals again really quickly. Any short-term goals that you have, you use the savings instruments that are available to you, okay, for your short-term goals. And what are my savings instruments? These are low risk, low interest rate, not very volatile um, options. What are they? It's like putting your money in a savings account or a fixed deposit or a recurring deposit in a bank. These are suitable for emergency fund, or you're saving for a vacation. And then again, you went on that vacation, that money is spent. Now you want to go on another vacation, start saving again for that one, right? And these things you can do in a bank. Your short term goals can be achieved through savings. But your long term goals, like your retirement, leaving something for your children, having a house, being debt free, all these things are long term goals where you need to be more growth focused. You should be willing to take a little more risk over a long period of time. Remember, you're starting when you're in your 20s and you're thinking about retirement. It's like 60, 65, who knows what it'll be by the time you guys are old. You're worrying about that right now. So you have a long time to grow your money. So for that, you must think about investing your money, not just putting it in a fixed deposit or a recurring deposit. And the reason will be clear here, because your fixed deposit or your recurring or your savings account give you not great rates, right? These are your interest rates. This is just 8%. This is like an excellent rate. If you get FD May 8%, you should be like happy. Okay. Well, so FD, you guys, I'm sure you know, is like, suppose you get a lump sum. Let's say, go back to Arya. She got 1 lakh rupees as bonus. She could have taken that and put it in a fixed deposit, the whole 1 lakh, right? At one go. And she says, okay, I'm putting it for 3 years. And her interest rate would be a little higher. If she puts it for 1 year, her interest rate on FD will be lower. Okay. Now, a recurring deposit is something that I say, okay, I'm going to put 500 rupees every month in this recurring deposit. It's a regular contribution. I will do 500 a month in this account for my phone. This recurring deposit is for my saving for my phone. I can have another recurring deposit. Oh, this one I'm saving for my, let's say, for a medium term goal like a motorcycle or a car that I want to buy. I'm going to put 1500 in that, right? So you've told your bank, or you figured it out on your app that this much goes, 500 goes here for my phone. In your mind, you know it's for your phone, and another 1500 goes for my bike or my car. This you keep doing all the time. So these are again short term goals that you are trying to achieve with your bank options. And when you open a bank account, make sure you know what their policies are. If there's a minimum balance requirement, otherwise they charge you fees. They may also charge you fees for ATM or your debit card. And how are there? Because all of us now use our phones for digital, for banking also. Please check how their apps are. Get a review on Reddit or somewhere like, oh yeah, this is horrible, this is great. And then choose your bank account safely. Okay. Don't go just because a bank is giving you very high interest rate. Don't just go there. Think about how reliable, how safe that bank is as well. Okay. Great. So these are my banking options for savings. Okay. Now, we are going to think about investments. But before we can get there, we need to learn a little bit about what inflation is. What is inflation? Inflation is महंगाई, कितना बढ़ रहा है, how expensive are things getting on a daily basis or on an annual basis. That's the rate of increase in the price of goods over a period of time. Okay. So in March 2025, we came up, our inflation was the lowest it had been in a very long time at 3.34% annually. So that's actually very good. Okay. Krishna Priya, I'll need the poll in like 10 seconds. Okay.
Sure.
Now, I want you guys to go back in time. Think that the year is 1964. You have 100 rupees and you're going and you have to buy rice. Can you please guess how many kgs of rice can you buy with the 100 rupees? Now we can open the poll up. Please think about it. The year is 1964. You have 100 rupees, which is I think a lot of money way back then. How much rice do you think you are buying with the 100 rupees? So the options are 71 kgs, 109 kgs, 142 kgs, 167 kgs. Yeah, very good. It's just a guess. Nobody expects you to know this, right? Like, what is your guess that, okay, great. A few more, please. Yeah. Okay. So yeah, a lot of you have said, very few of you have said 71 kgs, which is right. Like 71 kgs, it's not 71 kgs. It's at least more than 100 kgs that you can buy with 100 rupees. Okay. The correct answer is actually 142 kgs. The price of rice was 70 paisa per kg. Okay. Mandi prices in 1964. So 142 kgs you can buy. Okay, so now I've closed that. Any guesses what you can buy today? It's not a poll, but just guess with $100 in your mind. That's fine. So now look at this graph. In 1964, at 70 paisa, that was the rate. And now look at the price. Like this also, by the way, 46.5 rupees per kg is like mandi prices of not the best quality quality rice, some average price this is, okay? For 100 rupees, today I would get 2.15 kgs of rice. But in 1964, I could get 142 kgs of rice. This is just the rice price over this time period. Can you see how much that how much the price of rice has increased? Okay, now let's go back again to 1964, guys. Think about this. Your great grandparents, your grandparents may not have been born. Okay, anyway, your great grandparents have decided, they had this 100 rupees and they said, okay, I am going to invest in Bombay Stock Exchange, 100 rupees in 1964, 100 1965 for 10 years till 1974, 75. Every year they've invested 100 rupees in the Bombay Stock Exchange, and after that they stopped. They're like, no more, I can't invest anymore. So for 10 years, so 1,000 rupees overall they have invested in Bombay Stock Exchange. Now, somehow you went to your great grandparents' house and you found the certificate of this particular stock or investment that they made. And you say, Arre, let me see and go and figure out how much is this 1,000 rupees worth today, right? The investment that they made, how much do you think that is today? Please use the poll and respond. So think about it. It's 100 rupees per year for 10 years. Total investment is 1,000. And today you find those certificates and you say, I wonder how much this is worth. And you go check. It's going to be a complicated process to check, but you go check somehow. And you will get the value of that investment. 1,000 rupees becomes how much now? Okay. Some people are saying 66 lakhs. Some are saying 63,000. Nobody is saying 16,000, which is good because it's definitely way more than 16,000. Okay. Yeah, please keep going. A few more if possible. Again, these are guesses. Nobody is judging anyone here. All right. Okay. Very good. Okay. So most of you, about 50% of you have said it is going to be worth 66,000, 66 lakhs. Some of you have said 6 lakhs. I'm going to disappoint the 66 lakh wala people. The value of this 1,000 rupees in today's time is going to be 6.36 lakhs, which is not a small amount, which is more than the annual in-hand salary that our dear Arya has. So imagine 1,000 rupees invested over a period of 10 years has now reached a value of more than 6.36 lakhs, right? And this, again, we have done at only 12% per annum returns, etc. So as you can see, initially, till like 1973, there's no big difference, no big difference. Suddenly, this snowballing effect happens where when you have spent enough time invested in the market, if you have left your money there and allowing it to grow, the power of compounding takes over and your money grows as you can see, this investment growth is, this slope is what we are aiming for, right? And that happens only when we invest early or we invest for a long period of time. Okay, so that's a lot of money your grandparents have left you. Now, the reason I was talking about this whole inflation business and this, how my investment, how your grandparents' investment has, oh, sorry, I don't know what I did. Hang on. Sorry, guys. I just wanted to go to the previous slide. Yeah. I'm going to close the poll. Don't need it. Yeah. So as you can see, inflation with the rice example, and you can also see the investment growth. This next chart is going to show you what 1,000 rupees of grocery, what if you had 1,000 rupees in the year 2000, how much money, whatever food you could buy with that 1,000 rupees in 2000, how much would you have to spend today? You would have to spend about 3,700 for the same. Let's say you bought 1 kg dal, 1 kg rice, sugar, salt, ghee, oil, blah, 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 for 1,000 rupees in the year 2000 for the same, exact same weight, exact same items. You would have to pay 3,700 in today's money. So you can see that is our inflation in just 25 years. Now, the same thing, if I have invested 1,000 rupees in Nifty, I'll tell you about Nifty, etc. soon. If I've invested that money, that's the purple line. My goal in investing is to make sure this gap, the gap between the orange and purple line, is huge, so that whatever money I have invested is growing at a much faster rate than inflation. Inflation is going up. We know that the rate of inflation is going up, but we have to make sure our investment is doing better, so that this gap between these two is more and more and more, so that even though prices are going up, my investments are doing well, my savings are doing well, so that I don't feel the pinch. Okay. So, and imagine if you stop earning and you're just relying on these investments, then also this helps, right? Your investments need to have, you have to have this investment to beat inflation. Like if nothing else, if not saving for retirement, blah, 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 this is the main reason that you should be investing your money. Okay. So that's our goal of investment. How do we invest money? So we are going to invest in stocks, bonds, mutual funds, exchange traded funds, and we're going to go into each of these. Okay. What's a stock? Stock is when you buy a stock, you buy a portion of that company, a share, an ownership in that company. Okay. I've made a list of here. These prices were yesterday, and these are the top stocks in India based on their market capitalization. Market cap is nothing but the stock price times the number of shares outstanding in the market, right? So Reliance Industries is our biggest, highest market cap, then HDFC Bank, then Bharti Airtel, then TCS. Okay. So if you know about a company in detail, you know, oh, management is good, they have many plans for growth in the future, then you should invest in a stock. Otherwise, right now, my advice to you is don't invest in individual stocks. You can invest in these companies, but in another way, which we are going to talk about. And in case you do invest in stocks, please don't do this day trading business like, oh, aaj invest karenge, parson paisa nikalenge. That is going to be, in the long run, you will not make money. Okay. So these are stocks. Bonds are again another option for you, which is when companies or governments want to raise money. But here they are not going to give you any ownership. They're basically looking for a loan. They say, okay, Preeti, can you give me a loan and I will repay the loan. And in the meantime, I will also give you interest on this loan. That interest in case of bonds is called the coupon rate. Okay. So company or the government issues a bond. You say, okay, when you buy it, which is you're giving them that loan, so then you'll get that money back for sure, but you will also get some interest payment. Bonds are rated AAA, double A, triple B, double B, B, C, D, etc., etc. The best kind of bonds are the AAA bonds, and D stands for default. So the chances of this company going into default are high. And that's why the default interest rate, they are willing to pay you a higher interest rate. As you can see here, the AAA and triple B, how different the coupon rate is. Triple B guy knows I'm not that good. I'm not as good as a triple rate. So somebody who wants to buy this bond will expect a higher interest rate or coupon rate. So he is willing to give us better return, but it's also a bit more risky than the triple A bond. Okay, so these are your bonds. Now, coming to mutual funds, my favorite topic. Okay, so mutual funds is a easy way to think about it is if all of us on this webinar right now we say, okay, we are going to put our money together, whatever it is. I put 1,000, somebody puts 5, somebody puts 10, doesn't matter. Everybody puts their money together and we go and buy one mutual fund ka shares. Now that share can depend. If it costs 1,000 rupees, then because I put only 1,000, I will get one share. Somebody who's put 5,000 will get 5 shares. So it depends on what you have put. Now all of us go and invest in this mutual fund. And what is this mutual fund made of? It is made up of shares or bonds of many different companies. Okay. So when I buy a mutual fund, I end up getting a little sliver. So let's say it's made up of Reliance, HDFC, Bharti, and TCS. Okay. So I'm going to buy, instead of buying individual stocks, I'm saying I'm going to buy all four of them, which are part of this mutual fund. So a little bit of my money will go to Reliance, some will go to Bharti, will go to this thing, that thing. The purpose of this is that in case Reliance does well, great, my mutual fund will go up. In case Reliance doesn't do well, I'm hoping that the other three, TCS, Bharti, and Airtel, HDFC, will do well. And so my losses will not be so bad. Okay. So the idea is that you spread your money, or what they call in investment terms, you diversify. You put your money in different companies through one mutual fund. Okay. Now, so the investors is all of us. We put all our money together, give it to this person, a fund manager, who invests in this a different proportion of Reliance, HDFC, TCS, Bharti Airtel, and then it generates some returns, and those returns are passed back to us. Okay. So mutual funds are managed and created by asset management companies. Many asset management companies are there. Kotak, this, that, HDFC Mutual Fund, SBI Mutual Fund. These are just two examples, okay? And within this asset management company, there's these persons called fund managers who will decide what that percentage should be, where should I put this money that these people have given me to invest, okay? Every mutual fund, so now mutual funds, you cannot trade on Bombay Stock Exchange, or BSE or National Stock Exchange. You have to buy and sell it from the AMC or through other brokers like Grow, Zerodha, etc. Okay. And so unlike stocks which go up and down all day when the market is open, the price of one unit of a mutual fund is decided at the end of day, and that is called the net asset value. Okay. After the markets have closed. Why? Because now this fund manager has to go and see, oh, how did Reliance do? Oh, how did HDFC, Bharti, and this? Oh, now I have to calculate it and come up with this, whether it went up or down, this net asset value. Okay. So hence you can only know what that was worth at the end of the day every day. Okay. Now, a high NAV doesn't mean it's a great mutual fund. The one way to look at whether a mutual fund is good or not is if it beats its benchmark. So SEBI requires that every fund manager tells, oh, this particular mutual fund has this benchmark. So now that benchmark is like an index, which is like a bunch of like Nifty 50 or something. So you can say, oh, Nifty 50 got only 12% return, but my mutual fund got 14% return. Wow, my mutual fund is doing better. But if yours is getting 8% and Nifty 50 is getting 12, then you know that you should get your money out of this fund. Okay, so that's a little bit about mutual funds. Now, mutual funds can be divided into many types. If all those companies, remember that bunch of companies that the fund manager chooses, if all of them are bonds, then it's called a debt fund. If all those companies that he invests are stocks of companies, then it's an equity fund. And a hybrid, of course, is a mixture of debt and equity, and it may sometimes also have like commodity or who knows, some other kinds. It's a mixture. And also, debt funds have low risk, low return. Equity funds will have high risk, high return. Okay, and these are some example percentages you can see. Okay, now for equity funds, which means the stocks, the little slivers that he's investing in are all stocks, not bonds. That can be divided into many different types, which is based on market capitalization. A large cap mutual fund, which means it is the top 100 companies that are trading in BSE or NSE today. Okay. Then mid cap is, and again, they also have a turnover or some, like not turnover, their market cap is above 50,000 crores. Then the mid cap, their market cap is between 15 to 50, and small cap, small capitalization, is below 15,000 crores. Again, you will see that smaller caps give you better returns, but they are risky. These companies can go bankrupt, can go into losses, but the solid ones, like for a Reliance or an HDFC Bank to fail, would require like a big turmoil in the market. So those large cap companies, they know that they're going to be around for a long time, so they can get away with smaller returns than the small caps. You can see here 12 to 16, 18 to 27. Okay. Now, every mutual fund, like on the asset management company page, when they have listed their mutual funds, every mutual fund has to tell you how risky is it, low risk or very high risk. And based on your risk profile, like, oh, I'm okay to take risk right now, you choose that. Okay. Now, mutual funds can be, so remember that fund manager. Now, if the fund manager says, I'm very smart and I'm going to invest all this money based on my knowledge, every day I can change this percentage. Aaj 20% reliance mein hai, kal 13, parson 12.5. So if he's doing that, that means he or she is actively managing the fund, and they will never share this with you that that, oh, today I put 12%. You just have to trust this guy, like, oh, he's very smart and he will manage my money well, etc. I mean, this is not a one-on-one thing, but this is an actively managed fund. But that's a lot of, I feel that's a high risk to take. What if he's not as good as he claims he is, right? Instead, we can go with what is called as passively managed funds, which say, okay, in Nifty 50, what is the percentage of each of these companies? And I am going to copy exactly that percentage. Copy A to A, B to B, C to C. Everything I'm going to copy and be a exact copy of that index. This way, if the index goes up, your mutual fund goes up. And there is like no guesswork, like, oh, I wonder what that fund manager is doing. No, you know that they are going to follow. If you don't have to go look at your particular mutual fund, oh, aaj Sensex upar gaya. Then you say, oh, my mutual fund, which mirrors the Sensex, has also gone up. So that makes it easier. When I say this index, I mean just like there's many ways to put companies together. So let's say Sensex, for example, is the 30 largest and actively traded companies on Bombay Stock Exchange. Now, Nifty 50 is the top 50 companies traded on National Stock Exchange. Then there's Nifty Next 50. There's many, 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 many indexes. Okay. So you can see that. All right. The last one is exchange traded funds. I already mentioned that mutual funds are not traded on the stock market, right? But these funds, this is like a mutual fund, but it is traded on the stock market. So you can consider these if you want to buy and sell, which again, I don't recommend, but you can see they are more liquid. Like if you want to, suddenly you have a need of money and at 12 o'clock in the afternoon, you want to sell, you can sell an ETF versus a buy and sell order for mutual fund will happen only at the end of the trading day, later. Okay, so these are very similar to mutual funds, but the only difference is that they are traded throughout the day. You can have equity ETFs, you can have debt ETFs. Again, you understand equity means stocks, debt means bonds. Commodity ETFs is you can have gold, silver, oil, agri products, etc. A gold ETF again is a very good way to get exposure to gold without actually owning physical gold, which anybody can steal and say, no, it's mine, it's gone, right? So gold ETF, that way you're, if the gold prices are going up as they are, you are already invested in the market and you're making some money out of it. And international ETFs. It's very hard sitting in India to invest abroad. So these companies like Motilal Oswal is a AMC, which has come up with this NASDAQ 100 ETF. This basically, NASDAQ is the US stock market. It mirrors the index of the top 100 performing non-financial companies, okay? And it mirrors that. So you can say, oh, I'm going to buy this ETF. Then whatever the companies abroad are doing, if they're doing well or not, then that way you're invested in the international market also. All right. So these are a few instruments you can use. Now, how do we get started? So for stocks, for bonds, and for ETFs, you need a demat account and you need a trading account. Most of you will be more than happy with me too, with a discount broker, which is like a Zerodha or a Grow or an Upstocks. They don't have very high fees. A full service broker, again, is like an ICICI Direct and these guys. These are saying, sir, ma'am, I'm going to give you advice on your money. This, I think, if you start earning crores and crores and crores and crores of rupees, then, and you don't know, oh my God, I have so much money, I don't know what to do, then go get a full service broker. Most of us, luckily, are going to be just fine with a discount broker and a little bit of chat GPT knowledge, and we will be just fine with a regular demat account with a discount broker. Okay. But for mutual funds, because you don't need demat and all that, you can directly buy it from the asset management company or through discount brokers like Grow. You do not need a demat account. That's only for bond, stocks, and ETF. Or sometimes your bank, again on your app, they may allow you to invest in a mutual fund. Okay. All right. Everybody asks, what is SIP? SIP. SIP is nothing but a method of investing. It stands for Systematic Investment Plan, where you say every month, I'm going to put 500 rupees in this equity fund, or I'm going to put 1,000 rupees in this bond fund. You choose the mutual fund scheme, you decide how much money, 500,000, and you say every week or every month, whatever your interval is. That is systematic investment planning. Okay. So what happens is, because you're investing a very small amount over a period of time, if it's going up or down, that way, again, you're making use of that slope. You're going to ride the storms. If it's going up, great. If it's going down, also great, because you've been investing little at different price points. So you end up doing better. You get a better return if you're investing small amounts at regular intervals. Okay, investment tips. Please start in your 20s. Look at this graph and look at this last column. In January 2025, 40% of the registered investor base was under the age of 30. That's all your contemporaries. So you need to quickly join this group. Okay. As you can see, it is the biggest chunk. That young group is investing a lot. So please get on that boat. Start small with a SIP, and as your money, as your income increases, please increase that SIP amount from 500 to 700, 1,000 to 2,000, whatever it is. Right now, I would recommend don't pick individual stocks. Don't invest in individual stocks. Invest only in mutual funds. As you get more knowledgeable, as you think you're learning a little bit more and you feel comfortable, then invest in individual stocks. Why? Because it's risky. If that one company does well, great, you made a lot of money. But if it doesn't do well, then you have lost a lot of money also. In mutual funds, your risk is diversified. Okay. Now, for your short term goals, again, going back to financial goals, please put your money in savings account or FD or something else. For your long term goals, your retirement, your house, etc., big things, invest in mutual funds. Oops. Okay. For mutual funds, there's one more thing that you please remember, always use the direct plan. This has fewer fees versus the regular plan. It sounds very confusing. Oh, regular. No, say direct, direct. I want a direct mutual fund plan. Okay. And remember, mutual funds are like a long term product. Don't chase quick profits. Oh, मुझे आज खरीद के परसों बेचना है. Never. Okay. Passively managed funds, where the fund manager is not changing the ratio every day, are better for most of us. Okay. I would recommend you start, if you want to start investing, start with an indexed, something which is benchmarked to an index fund, or a flexi cap. Flexi cap is again where the market cap, there's a large, mid, and small market cap is split up, right? That same mutual fund, 60% of the funds are in large cap, 30 are in mid cap, and small 10% is in small cap. Okay. I would avoid purely small cap mutual funds right now because they're high volatility. You don't know what may happen. It's fine to not get great returns, but to get steady returns, right? Like you will get a return. It may go up or down. Or even thematic mutual funds. Thematic are like, oh, agri based, oh, like oil and gas company based, like that kind of things. Okay. As you get more information and more knowledge and experience, please invest. And last but not the least, know your risk profile. How much risk are you willing to take? Okay. The giraffe might think it's not deep, but this poor little mouse or rabbit may think it is very deep. Okay. Yeah. Okay. Now, unfortunately, rushing through insurance. Insurance. Why do we buy insurance? Different types and choosing the right insurance. So, our main goal for buying insurance is if something goes wrong, if I get into an accident, if my car breaks down, my motorcycle breaks down, is there somebody else who can help me pay for all these expenses, right? I'm spreading this cost of hospitalization, of car repair with somebody else, all right? So, that is the main goal of buying insurance. Okay. It could be because you have medical expenses, maybe the earning member dies, maybe they get injured and they cannot work, and, accidents or fire, anything, right? So that's our goal. The types of insurance generally are basically two types: general insurance and life insurance. General is very normal, like the healthcare, auto, homeowners insurance. That is general insurance that you figure out when on your own time. But today, for today's purpose, I just want to talk about life insurance. Life insurance happens when the earning member dies or the earning member is unable to work. Okay, so there are many different types of life insurance. Uh, Again, in life insurance, please look for only term life insurance. And now, in the latest budget, I think they have removed the GST for any life insurance that you buy. Like, so if you're buying certain thing, you have to pay no GST as an individual. But a company, if it's buying for all its employees, they still have to pay. That's a different thing. Now we don't have to worry about that. So we don't have to pay GST. So it's a good thing. Okay. Term life basically says, okay, I'm the earning member. On me, my two children, husband are dependent. If I die, who's going to take care of them? Okay, if I die, I want to have this much money, 2 crores money, go to them so that they can manage their expenses. That is term life insurance. All these other options are just different products that the insurance companies came up with. None of them I mean, they all promise different things. Whole life gives you things when you have crossed the age of 100. Endowment plan is like it is going to save some money for you and give you life insurance. I can save money on my own. Okay. I don't need to buy an insurance plan to save money. I can go to a bank, open an FD. Even ULIP you will hear all the time. Oh, ULIP mein karna chahiye, ULIP mein. No, because ULIP is nothing but they are going to take your money, put some towards your term life, and the rest they're going to invest. Why should you trust somebody else who works at an insurance company to invest for you when you can do it yourself, right? So, all these products, please ignore them. If you're buying life insurance, focus on term life only. Okay, term life. Please distinguish between insurance and investment products. We don't need to combine the two. Okay, last, loan repayment. All loans are not bad, right? Why do I say that? Because if I'm taking a loan for my education, if I'm going to make sure that this loan is going to suddenly increase my income from 8 lakhs to 28 lakhs, just because I have done an MBA, which I don't think helps, or whatever. If I am taking an education loan and I think it's going to help me, then it's a good loan. If I'm taking a loan to buy a house because I'm now going to save on rent and whatever money I pay my mortgage or my house loan, that money is actually my money. I'm investing in my own house, right? That's a good loan. A business loan, if I think I'm going to make more money by investing in this business, then yes. So anytime you're investing in your future and there is a potential to increase your net worth, then it's a good debt. But anytime you're just doing taking a loan, um, for a vacation, for an expensive anything, like any other loan which is not necessary purchase, is a bad loan. So hence all your credit card loans, credit card and your personal loans. Oh my god, there's so many ads for personal loans, and they'll make this wonderful beach picture with suitcases and like a sun umbrella and make it so tempting. Oh, personal loans at 9%. Do not fall for all this. Save for your vacation. You will enjoy it just as much, in fact more, because you don't have to worry when you come back. You don't have to worry about this loan you have taken. Okay. Now, when you take a loan, please borrow only what you need. Don't borrow extra. Look at the interest rate at different places. Go with the lowest interest rate. Make sure you're paying back your loan quickly. In this last column, you can see this 167. The dark brown stands for the interest payment, and the yellow is your loan. So the longer you wait, for 25 years, if I waited to repay my loan, I have ended up paying so much extra. So try to repay your loan very quickly. Okay. And also, your credit history depends on your repayment of your loans. Your credit score is like a 3-digit number. Okay. It goes from like 300 to 900. So anything below 580 or below 600 is bad. You want to be above this 700 range. Okay, 650, 700 range. You want to be in this section. Why? Because this helps you get better loans. It is a way in which a bank or a lending company will say, oh, should I give the loan to Preeti or should I give it to ABC or to Arya? Oh, Arya has a better credit score. Let me give it to her. Preeti may or may not repay this loan because she has a bad credit score. Okay. The ways to improve your credit score is make sure you pay your bills on time. If you have a credit card, pay up your credit card on time. Maintain a long credit history. I have a credit card. I've had it for 5 years. Look, I've repaid every month. That automatically improves your credit history. Okay. The one thing I would highly recommend is like when any lender will check your credit score, right? They want to see, oh, will this guy return the money or not? When you want to get a loan, please, there's a difference between calling and asking and going to the office and asking in person what is the interest rate. Don't fill up multiple loan applications. When you fill up a loan application, you are giving permission to someone to go check your credit score. And the more number of times somebody goes and checks your credit score, that affects your credit rating. Okay, so don't submit a loan application just because you want to say मैंने 3 जगह loan apply किया है. No, do your research, apply only in one place. Okay, if you check your credit score on your own, that has no impact. Okay, now I promise this will take only 1 more minute. Uh, so I'm going to give you 2 strategies of how to repay your loan. Let's say these are some loans that somebody has. The first and foremost thing is to have a clear picture in your mind. How much is my minimum monthly payment? What is the interest rate for this loan? How much remaining balance do I have? Okay. So let's say this is the this is the picture that you finally come up with. So knowing this itself should not give you stress, but gives you an idea of what you want to attack first. So here, look at the credit card loan. It has a very high interest rate. So the first strategy is actually to pay off your highest interest loan first. In this case, it was our credit card loan. So once you pay this, that means you're paying far less interest rate, right? So you'll become debt free. You'll repay everything in that same order. So 36% highest, then 16, then 13, then 9. You are debt free in 27 months. Okay. The other strategy is to pay off the smallest loan. You say, oh, yaar, let me just feel better that I have only 3 loans instead of 4. So you pay the smallest amount. You say, oh, 15,000 loan, done. I repaid it. Then you move on to the next, and next. This way, also, you will be debt free, but you would have paid a little more interest. Both strategies work. No, it depends on how you are motivated. But the main thing to remember is try and be debt free always, other than a mortgage. Okay, that's it, guys. I will take your questions now if you have any. Okay, thank you.
Yeah, thank you, Ms. Preeti. We have few questions. I'll
Okay,
just quickly read it out.
you want to just share it on the
Sure.
screen?
Yeah, so it's already there in the Q&A box. Can you
Wait,
see
let
the
me just
Q&A
1 second.
box?
No, no,
All
I
right. Okay.
can't. Uh, 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 uh. Sorry.
There is a Q&A box at the like below part.
Chat?
Yeah,
No.
in the not in the chat, or like you can just
Uh,
see the icons, right?
I'm trying. I'm trying my best. More Q&A.
So there is a
Yeah,
question mark
got
box.
it, got it,
Got it.
got it.
Oh, okay.
Hmm. I'm working in a company starting the financial year with 8 lakhs per annum, but after a few months, I switched to another opportunity with higher salary or got laid off. Which salary would be considered for paying tax? So you will calculate you have earned money in the first few months. That is going to be there. You're going to earn money in the next month. So it's not going to be you're going to do it as a proportion of the months. It's not going to be like, oh, now you have to pay based on 12 lakhs per annum. You have to see, oh, first few months I was getting 8 lakhs. So how much is that? What was my income there? The next months I was getting at 12 lakhs. What is my income there? Okay. Do credit cards charge interest even if I pay back within 1 month? No, they cannot. They don't typically charge. But even if you miss by like a little day or so, then they charge. But there is always a credit card fee that you're paying, even whether or not you are repaying within a month. There's always a fee that you pay. That anyway you have to pay. Can you please share practical ways to tackle small, repeated financial losses that happen due to lack of information or hidden charges? Um, I suspect you're thinking about banks and credit cards. So hidden charges are sometimes there are charges for maintaining a minimum balance, or for credit cards, again, if you're not paying or you're just doing the minimum payment, then minimum monthly payment or an EMI, and just postponing the loan for a later date. Ideally, it's better to know what all you owe at one shot and try and pay it off as soon as possible. I'm not sure what I understand by small repeated financial losses. If you want to rewrite it, explain this in a question again below, I'll try and answer that specifically. Being a student without income, it is difficult to save money, and we can ask money from parents for many of our wants like travel. Are there any ways to earn and save money as a student? Okay. So my son is in college, and I pay him a certain amount every month. What I say is, this is the money that you have. And what he does is, with that, if he really wants to buy something, then he will, to be honest, eat less outside. He will spend less money outside, and he will save a little bit, bit by little bit. Because one thing your parents should make it clear is that you're not getting any extra money for all these fun things. Okay. I know you're a student. I would minimize, small things that I tell my children, and I will tell you, is that please minimize your Swiggy, minimize your, if you're, try and take public transport as much as possible. Um, you know, share bills. Don't be very, very generous and say, oh, no, no, I will pay for them or this or that. I know all that we learned today is more relevant for people with income. I hope you get to become an incoming earning member very soon. Okay, can we get this PDF or PPT? Yes, you will get a PDF with more details. Absolutely, you will get it. Ma'am, SBI is offering lifetime free credit card for students. Shall I take it? How is it different from traditional credit cards? I'm sorry, Madhu, I would have to go look. What do they mean by free credit card? And is it relevant only? First of all, it will be active. Will it be active only till you are a student? Will the terms change the moment you are no longer a student? You can take it now. Check their fees. What are their, if they say free, what all is free, right? How much is free? Are they not charging you for getting a credit card? So just figure it out. Definitely take it if they're giving it to you, at least while you're a student, and ask what happens if you have to close it. Like, I don't want it. If I don't want it, what happens? Okay. All right. I've gotten 2 premium credit cards in the final year of my college as part of an exclusive offer for zero cost for life. How to use these 2 cards wisely? How can I use these credit cards to build a good credit history and CIBIL score? Okay. So, to build a good credit history, if you're using the credit cards, make sure you repay that right away in that month. Number one. Okay. And getting many credit cards is not a big deal. When you start earning, you will get even many more credit cards. The thing is, I look at it as temptation, like, oh, I can buy this on this credit card. Is credit card pe nahi, us pe kharidenge. Um, it's fine. It's okay to have many credit cards, but look at things which are giving you, if they're giving you something like a fuel benefit, like you go fill up gas, then you will get this much money. Or if, for example, if many of you may be traveling for work soon, does it give you lounge access? Does it give you any other freebies? See what you're getting, and don't necessarily fall in the trap of having more than one credit card. One is plenty. Focus on it. Make sure you are using it well. Pay every month. Don't go beyond your payments. All right. Thank you so much, guys. I'm sorry this has taken very, very long. Any other questions? There's an issue with the form, I guess. La la la. Okay, no. All right. Uh,
Scholars, I'll just check it with the form, like what happened exactly. Thank you for letting me know. And
no.
Miss Preeti, like, can we share the PPT with the scholars, or could you share it with us?
Yeah.
We can
So
circulate.
I normally share like a PDF document, and I'll share it with you or with Taruna, someone at FFE, and you can forward it to the students. All right. Thank you all. You've been so patient. So many of you are still here. I really appreciate it. I hope you learned something, and you will follow, some of the tips I have shared with you. Thank you.
And thank you so much, Miss Preeti. And I would also like to tell you that it was really great of you to take recommendations from our scholars from the previous sessions
Yeah, yeah.
and
Every
design
time I
it in
feel
a
I'm
better.
learning something new. Yeah.
And we are so happy that I'm sure this has made our scholars learning more easier about the
Yeah.
financial literacy today. And thank you
Thank
all scholars for your time
thank
and
you
active
guys. Thank
participation. Yeah.
Yeah.
Thank you. Have a
Bye.
great day.
Bye.